if you've traded options on Robinhood for a while, you've probably seen accounts that look like this. Hopefully not your own, but it's possible. Or this, or this. If you browsed Wall Street Bets, I guarantee you've seen some of these because that's where I got them. And why is it so common for options traders to blow up their accounts like this? Well, there's two reasons why. Number one, they like to buy out of the money options. And out of the money options are very tempting because they give you a lot of leverage. If you're right, you can win pretty dang big. But they're also more like scratch-off lottery tickets than an actual trading strategy because they expose you to a lot of risk. And then there's another second reason is because options buyers deal with theta. Each day that passes, the value of the premium of their options decays off a little bit. So where does this money go? It doesn't just evaporate, all this money that this guy has lost. It goes into the pockets of the people who sold them the options. And that's what we're going to talk about today is how you can be an options seller, how you can profit off of each day passing, so basically profiting off of theta, and how you can profit off of people wanting to buy out of the money options. So we're going to do that through credit spreads. Credit spreads allow people with small accounts to be net short on options and profit off of these things that we just discussed. So if you don't know what options are really, you're probably already left, but if you haven't, go ahead and click the link in the top right-hand corner. It will take you to an options tutorial I did, and it'll explain the basics to you. If you do know what a call and a put is, generally speaking, stick around and find out what credit spreads are and how you can trade them today. We're going to start by building together a credit put spread or a bull put spread. This capitalizes on selling to open a put, which is a bullish move. Because remember, if you're buying a put, you're bearish, but if you're selling, it's opposite of buying, you're now bullish. And you'll see what I'm talking about here in a second. But we're going to have to start from the basics and work up from there. So what we're looking at here is a profit loss diagram of just a normal boring old put, a long put. So you bought it at expiration day. So on the x-axis, we have a bunch of different stock prices increasing as it goes to the right. On the y-axis, we have profit and loss. And so this red line here, or this red obtuse angle, is the profit and loss given different stock prices. So remember, when you're long a put or you buy a put, your max loss is going to be how much you paid for it. And in this example, your max loss is $53. That's how much you paid to enter the trade, and that's the max you can lose. Now you've reached your max loss on expiration day if it is trading above your strike price. So that means that this put has a strike of 26. And this is after all that time value has decayed off. This would look different prior to expiration day, but most people like to look at these diagrams on expiration day. Makes things a little bit easier to understand. Your max profit is, I forgot the actual number. This is an actual trade we're theoretically entering on AMD. This is a 5/31 expiration. Max profit is something in the thousands. We'll say it's $2,000 because the stock price can trade all the way to zero. And since you're bearish on the market, you can make money as it goes all the way down. Although if you wrote a put all the way to zero, I would be very impressed, and you'd be one lucky son of a gun. So it's unlikely you make that much, but you can theoretically make up to $2,000 in this trade. So this should all look pretty familiar to you if you've traded options before. But what might not look familiar is what it's like to sell to open this exact same put. And that's what we're looking at right here. Now, if I just flash between these two really quick, you can see how it's just mirrored over the x-axis. So let's say you sold this put to this guy. This guy bought it right here. Well, everything this person is experiencing is going to be the exact opposite of what you're experiencing as the option seller. See how it's flipped over the x-axis? So this guy's max loss of $53, he paid a $53 debit for this trade. That is going to be your max profit. So you're going to have a $53 credit. Now, what a credit means is that you get the $53 to start with when you enter this trade. It is credited to your account, and you get to keep this $53 if the put expires worthless. Because remember, if a put expires worthless out of the money, this guy loses his $53 that he entered for the trade, and the person who sells it to him, you get to keep the $53. So you hope that this put expires worthless so you can keep that $53. However, this guy's max profit back here, the one who bought it from you, is $2,000, which means that you have a max loss of $2,000. Because if the stock price trades all the way to zero, you're going to be paying that guy money all the way down, and your max loss at zero would be $2,000. So that's kind of a bummer, though, because $2,000 is a lot of money for most people, and that might be too much risk, let alone the fact that many people may not have big enough accounts to even enter this kind of trade, because Robinhood's going to hold that money aside as collateral in case the stock price does take a massive dump. So how can you benefit on the positive characteristics of selling to open options without exposing yourself to this much risk? Well, what you can do is you can sell to open this 26 strike put, but then also buy a further out of the money put as a hedge. And this is what ends up happening. Boom. So right here, we sell to open the 26 just as before, and we're going to sell to open it for a $53 credit. Remember back here, it's a $53 credit. So we're just going to write that down here for a second. So you sold to open the 26 for a $53 credit. And then as a hedge, you bought, so that's a bullish move, selling a put. As a hedge, you bought the 25 strike put, which is a bearish move. Now you pay a debit for that put, and for this one, you're paying a $23 debit. So what ends up happening is this is a net credit trade. Since you're getting more of a credit than you are paying a debit, what ends up happening is you get a $30 credit. So that's your max profit, is $30. So if you look back here, your max profit that was once $53 has now been significantly reduced to $30. So that's gone down a bit, which is a bit of a bummer. I'm not going to lie. But if you look over here, your max loss that was once $2,000 is hedged by the bearish instrument of just buying a put outright. And now your max loss is only going to be $70. So that is a significant decrease in risk for sure. So that allows people with small accounts to start trading net short positions and benefiting on the positive effects of theta and on people's desire to buy low probability of success options, so like out of the money options. Just because they give people more leverage, people tend to like to buy those, and you can capitalize on that kind of behavior. Anyway, going forward, keep in mind that on expiration day, your max profit is met when the stock price reaches the strike of the put you sold, and your max loss is met when the stock price is trading at or below the strike of the put you bought. And your break even is going to be somewhere in the middle. And we're going to get to that in a second. We are going to hop over to optionsprofitcalculator.com, which is a website that will help visualize everything we've discussed. And we'll also talk about how you can manipulate this trade to expose yourself to more or less risk, and what strikes you should be buying and selling these at. Also, we're going to go over assignment here in a little bit. Definitely don't trade this until you understand assignment completely. It's a very important part of these kind of trades. So let's hop on over there. Okay, so here we are at optionsprofitcalculator.com, and there's a link to this in the description if you want to tag along. Ooh, that was a nice rhyme. We are going to put together some put spreads. Oh my God, I'm on fire. So you're going to go up here and click put spread, and you'll see what this all does in a moment here. But we're going to trade it on AMD because why not? That's what we've been talking about. We are going to write our put first. So we're entering a hypothetical trade, and writing is synonymous with selling to open. So we're going to select our option here. At the top, you can see all the expiration dates for all of AMD's options. And we are going to choose the June 21st expiration. So on the left side, you can see calls, and on the right side, you can see puts. And right down the middle, you can see strike prices for all of those calls and puts, as well as the bid-ask price is for each of those calls and each of those puts. We're just going to focus on puts because we are creating a credit put spread. And I'm going to say put a lot during this, and I'm very sorry, especially because my pop filter isn't great. But we're going to focus on the mid price, and we want to sell an out of the money put because we want to capitalize on someone else's egregious trading behavior. In other words, when someone buys an out of the money put, they are making a pretty risky bet that the stock price is going to take a big downward move. And we want to capitalize on someone thinking it's going to take a larger downward move than that is actually going to happen. So we are going to sell to open the 25 strike put because we don't think that the stock price is going to trade below 25 before June 21st. So we're going to go ahead and click on that for a $38 credit. Now, we don't want to expose ourselves to the huge risk involved with selling to open a put alone, aka selling a naked put. So we want to buy one as a hedge. So let's go ahead and do that. So up here it says buy. We're going to select an option, and we're going to have the same expiration date, but we're going to buy one that's a little bit further out of the money. So since we sold the 25 strike put, we are going to buy the 24.50 for a $30 debit. So this whole trade, what do you get? Well, it was a $38 credit and a $30 debit. So the difference is an $8 credit that you get to keep if this whole trade expires worthless. Because remember, if you buy a put option and it expires worthless, you lose that $30. But if you sold one and it expires worthless, you keep the $38. So if you lost 30 but gained 38, you make $8. It's a net credit to your account. Okay, go ahead and click calculate and scroll down. So here you can see different days of the options life cycle, as well as different stock prices and your potential profit and loss given the day and stock price. So for example, if it's May 31st and it's now trading at $30, you potentially made $5 profit. Now this is affected by changes in implied volatility. If implied volatility increases, you are going to be losing money. And if it decreases, you'll be making money. So it's the exact opposite of just buying a long call or a long put. But anyway, this is a beautiful sight to behold because here we are at the current stock price of $28.08. And even if the stock price trades sideways and down before expiration, we can still collect our entire net credit and reach our maximum profit, even though it traded down And that's very different from a call, which I'll show you here in a second. So we just want it to trade above the strike price of the put we sold, because we want the put we sold to expire out of the money. So we want the stock price to be above the strike of the put we sold to collect our net, our maximum profit. If you want to get really specific, you actually want it to be trading above your break-even point. And you can see where your break-even point is right here. It's going to be, I don't know why it says 24.93, but it's going to be the strike of the put you sold minus the net credit. So that will give you a break even. But realistically, if you're just doing it on the fly, you want the stock price to be trading above the strike of the put you sold. Plus, if it's trading below the strike of the put you sold, you could potentially get assigned, and we'll talk about that in a bit. So just keep in mind, keep it in your mind as you want the stock price to trade above the strike of the put you sold to collect your total premium and make your max profit. Okay, that's the rule of thumb. Okay, so the stock price is trading at or above the strike of the put you sold. You get to keep that $8. That's awesome if it expires worthless. How about how much you're risking? Well, you can see that up here. This website actually calculates it for you. You're risking $42. Now, that's noticeably bigger than the amount you can make because this is a high probability trade. You're selling an out-of-the-money put, and that makes it a high probability trade. It allows the stock price to trade sideways and even down some, and you can still end up getting your maximum credit. So you're putting a little bit more money up at risk and putting more skin in the game because it is a high probability trade. Anyway, you hit that max loss at a price of $24.50 at expiry. Now, if you remember, $24.50 is the strike price of the put you bought at. So on expiration day, you've hit your max loss if the stock price is trading at or below the strike of the put you bought. Now, this is, to put everything all in perspective, this is a call, an at-the-money call. It has the same expiration date, June 21st. Look at how much red seeps into the top side. You can't have the stock price just trade sideways. You'll hit your max loss. And in fact, you have to have it trade up quite a bit for on expiration day to have you make any money at all. And that's the beauty of credit spreads. If I could just pop back to what we were looking at. Look at that. That's so much better. It can trade sideways and down. Sure, you're only making $8, but the probability of you making that $8 is incredibly high. And we'll actually get to how you can calculate that probability here in a minute. But that's just the beauty of credit spreads. So let's actually take a look and see how you can manipulate the spread to fit your risk profile and what you want out of the trade. So let's say you want to increase the risk a little bit to increase the potential profit you can make. So there's two ways you can do that. The first way is you can make it so instead of selling so far out of the money, maybe you sell a little bit closer to being in the money. So let's go ahead and see what that looks like. So instead of writing the June 21st 25 put, let's move it down $1 closer to being in the money. So let's move it down to 26. It's still out of the money, so it's not really a bad trade, but it's it's more likely that the stock price is going to hit 26 by June 21st than it is that the stock price is going to hit 25. So we also want to move our hedge down $1 as well. You can also call this put collateral for this one. I think that's actually the more common term. So go ahead and hit calculate. And now you can see our net credit is going to be $14. So you can make $14 if this whole spread expires worthless. And you're not risking as much. But the probability of this trade actually proving successful is going to be lower. It's probably still high because you can see all that green going down there, but it's going to be a little bit lower. But anyway, that's how you can increase the amount of you're risking to increase the potential amount you can make. So let's make it a little bit more drastic. Let's make it in the money. So let's sell to open the 29 strike, and we will buy the 28.50. Hit calculate. So now you can see you got a net credit of 29, which is great, and you're only risking $21. So it's a pretty decent trade as far as risk and reward. But if you look over here, look at that green. It's no longer dipping down into here because you want the stock price to trade up a little bit. You want it to be above the strike of the put you sold, which is $29. So you need the stock price to trade up a little bit. So the overall probability of success of this trade has gone down. And as a result, you can make more because you're less likely to make it, essentially. You're also risking less. So that's another thing. If you are uncomfortable with the amount you're risking in a high probability trade, maybe try just bringing the strikes a little bit closer in the money so that you're not risking as much. Okay, here we are at our original trade here. Let's say we don't feel comfortable moving our strikes up. We like the idea of keeping our selling the 25 strike put because we don't think the stock price is going to be going below 25. And we just don't like the idea of reducing our probability of success by increasing the strike of the put we sold. So we want to keep the strike of the put we sold right where it is. Well, you can do that and still increase risk to increase potential profits. And how do we do that? Well, we increase the distance between our strikes. So we're going to keep the 25 put because we like that one, but we're going to buy a bit of a further out of the money put as a hedge. So we bought the 24.50 originally. Let's go ahead and buy the 22 instead. Now, we bought a further out of the money put, which is going to be cheaper, and that's going to increase our net credit. So it increases the amount we could potentially make. So now if both of these expire worthless, we get to keep $30. However, if you hit calculate there, our maximum risk is now significantly more. It's going to be $270 at a price of $22 at expiry. Remember, this is the strike of the put we bought. So we still keep the high probability trade. If the stock price is still trading above 25 on expiration day, it expires worthless and we keep our credit. However, even though we have a high probability trade, if we end up being wrong, our max loss is going to be a lot more. So those are two ways you can increase your risk to increase your potential profits. Let's do a little bit of a real life trade-ish, or make it simulate a real trade using a stock chart here, so you can get the whole scope of how you might actually do it. So this is AMD. Let's say you saw this pop up, it fell down a little bit. You see a doji, you think it's going to keep continuing the upwards direction. And in fact, you don't think it's going to go below this price right here. Let's just put a line there within the next 2 days. And in fact, AMD has options that are expiring on May 31st, which is this day right here. So if you don't think it's going to trade below this, well, what you can do is you can sell a put with the strike close to this price. So let's go ahead and say we're going to sell the 27.50. We'll give ourselves a little room to breathe. So let's go back to options profit calculator and see what that looks like. So we're going to sell the 27.50. So let's go ahead and we're going to select our option, click on May 31st. We're selling the 27.50, and we're going to buy the, go back to May 31st. We're going to buy the 27 as a hedge here. So now if things trade above 27.50 by 2 days from now, it can expire worthless and you get to keep your $11 credit. However, if you look back here at the stock chart, if things bounce around and end up actually going down here within the next 2 days, you may end up hitting your max loss of $39. So that's how you would do it. Now, let's get into assignment, because it's important to note that when you're trading credit spreads like this close to their expiration dates, if they do expire in the money, you do incur a loss. And we're going to talk about what that loss is here. Let's go ahead and talk about assignment. And to do this, we have to refresh everybody on what it's like to exercise an in the money put. So let's go ahead and do that. So here, let's say you hypothetically bought a put with a $10 strike price. And if you remember, a put gives you the right, but not the obligation, or in other words, you can, but you don't have to. Sell 100 shares at the strike price. So that's what a put gives you the right to do. And you can do that with an in-the-money put for a profit. And you can see that this put is in the money because hypothetically the stock price is currently trading at $9. And since the strike is above the stock price, it is in the money. So let's go ahead and exercise this option for a profit. So we're going to sell 100 shares at the current strike price, which will result in a $1,000 credit to our account. Okay. This also leaves us in a short position. We are short stock. We did not own 100 shares to begin with. We sold short 100 shares at that strike price. So let's say we don't want to be short, or we just want to close the position to capitalize on profiting from exercising this option. So we just want to buy to close this position. So we're going to buy 100 shares at the current stock price, because that's the only stock price you can buy it at, unless you have other options in play. So let's go ahead and do that. You buy 100 shares at $9, and that's going to be a $900 debit. So you received $1,000 for selling 100 at $10, and you paid $900 for buying 100 at $9. Well, the net difference is going to be a $100 credit to your account. So you made $100 off of exercising this in the money put. And in fact, that's what it's always going to be if you're exercising a put that is $1 in the money. But let's talk a little bit more about what assignment is. You did not sell you did not sell the stock to just the air. Someone bought them from you. And it was the person who sold the put to you. So let's say you are the put seller. Instead of you buying this put, you sold this put. And let's say the person you sold this put to exercised it on you, just like we just did. Well, what would happen? Well, instead of you selling 100 shares at $10, you would have to buy 100 shares at $10 because you're buying it from the option buyer. So that would be a debit trade. You'd pay $1,000 to buy those shares from him. and then you want to go ahead and close your position, you have to sell those 100 shares back to the market, and you have to sell them at the current stock price, and you have to sell them, so that makes it a credit trade. So you sold it for $900, and if you bought it for $1,000 and sold for $900, then the difference is going to be basically a $100 loss. So that's the exact opposite of what happens for a put buyer, and that's the case if you are assigned a put that is $1 in the money, you lose $100. So how does this exactly play out when you're doing it in credit spreads? Well, let's talk about that. So being assigned on a credit put spread involves both exercising a put and being assigned a put. So it kind of combines both the things we were just talking about. Look at me, I was thinking ahead. So let's go ahead and run through an example to tie everything together. So let's say the stock price is trading at $10, and we have a credit put spread open. So we sold a put at the $12 strike, and we bought a put at the $11 strike. So this is in the money. This put that we sold is in the money, and let's say we get assigned that put that we sold. So we have to buy 100 shares at $12 because it's the opposite of exercising a put. We have to buy 100 shares at $12. So let's do that. So 100 shares, we have to buy it for $12. That's going to be a $1,200 debit. Now, if you had just sold this naked put, if you had the capital to do that, you could sell these shares back to the market for $10 each and incur a $200 loss, but that's not what we're going to do here. What Robinhood is automatically going to do for you, if you cannot handle this in your account, being long this much, $1,200 worth of the underlying stock, what Robinhood is going to do is it's going to exercise the put that you own, and it should happen automatically. So exercising that put means that you sell 100 shares at the strike, so we're going to do that. 100 shares at the $11 strike is going to be $1,100. There's a 1 in there, I promise. And it's going to be a credit. So we take the difference between these two because this is a debit and this is a credit, and our loss on the our loss incurred on being assigned on this credit spread is $100. Now that seems like a lot of math and mumbo jumbo, but there's actually a pattern here. You don't have to do this math every single time. In fact, all you have to do is take the difference between the strikes and multiply it by 100. So the difference between these two strikes is $1. Multiply that by 100, and wow, look at that. The most we could lose on being assigned, aside from brokerage fees, is $100. Same number there. Now, I do want to bring up how earlier we were talking about how you can increase your risk to increase your potential profit by making these strikes further apart. Well, if you do that, you end up risking more money if you are assigned. So if instead of this $11 put we had bought, instead of it was a 7-strike put, that makes the difference $5. 5 times 100 is obviously $500. So if you were assigned, you would lose $500 on this trade. Now, it's also worth noting that you are at a higher risk of being assigned if the deeper in the money the put you sold is, and the closer it is to expiration. In fact, you can be assigned at any time before expiration. Robinhood will hold aside the amount you can lose in assignment as collateral, and I'll show you that here in a little bit. It actually says it before you enter the trade that, for example, if we had done the $12 strike and $11 strike, it will say 100 is held aside from your account as collateral in case you are assigned. And I'll show you that here in a little bit. Also, Robinhood will try to close your position if it is in the money on expiration day. A couple hours before expiration, Robinhood will try to close it just to reduce the amount of risk you have of being assigned. And in fact, you can actually, your credit spread might be a little bit out of the money, but if it's not enough out of the money, Robinhood will actually still try to close it for you, which is kind of dumb. But they have to manage their risk. They run it through a little algorithm to decide if your spread is potentially going to end up in the money, if it's worth the risk of keeping it open, and if they decide it's not, they'll go ahead and close it for you. So just be aware that on expiration day, Robinhood might close your credit spread. Okay, let's go ahead and enter a real trade here. Let's say this is AMD, the stock chart we're looking at. Let's say we don't think that the stock price is going to go below the $26 mark because there seems to be a little bit of a level of support there. So we want to sell a put that's a little bit below that to give us some breathing room. So let's do that. So we're going to search AMD, tap on it, hit trade, and trade options. We're going to do one that's a month out so that we can collect some premium over time. They're going to be worth more, so we can sell this spread for a higher credit. So let's tap select in the upper right-hand corner, and we are going to sell a put. So make sure sell and put is selected. Let's go down. Let's sell the 25.50 put. So right there, we'll give ourselves a little bit of breathing room. So we're going to tap that one, and now we want to buy one as collateral. So we're going to tap buy, and we're going to buy one that's 50 cents more out of the money. So we're going to buy the 25 strike put. Now at the bottom, if you tap continue, you can see our put credit spread there. So hit review. Actually, before I hit review, if you, actually, let's hit review. If you type 1 there, that's one spread we want to enter. And you see the bid-ask spread there. Normally when you're buying options, like if you're buying a call, you have to buy at the ask price, aka the highest price listed there, in order for it to get filled immediately. But we are a net short, so we actually have to sell at the bid price, which would be the 0.10 for it to get filled immediately. However, sometimes buyers will meet us somewhere in between in the middle of the bid-ask spread. So let's try and sell it for an $11 credit and see if a buyer will meet us there and see if it'll get filled. So we're going to type 0.011, hit review. Now you can see there it says collateral, $50. Well, if you remember, this is the max I can lose if I get assigned. If you take the distance between the strikes, which is 50 cents, and multiply that by 100, that's the max you can lose, which is $50. So that's going to be withheld from your account in case you do get assigned. So we're going to swipe up to submit this guy and see what happens. Maybe it'll get filled. Boom, there you go. Now you have your put credit spread open. If you hit done, if you go back to your main little page there, you can see your put credit spread right there. Right now I have it showing the amount I've made today on it, which is nothing so far. But if you tap on that and you see last price, you can see your $11 credit there. Now you want this $11 credit to go to 0. This is showing the value of the spread. If it's worth $11, we want that spread to be worth less and less, because if it gets worth less and less, we get to keep that credit. So as that number goes down, if it went down to 10, that means we made $1. If it went down to 9, we made $2. It can actually go up, and if it went up to 13, we've lost a couple dollars, and so on. So you want this over the next month to decrease further and further. See right there, it went up to 12. So what happened? If I go to today's return, I've lost $1. So over the next month, if AMD stays above the put that we sold at, that price will go down lower and lower. And as it approaches 0, you're going to be making more and more money. And if it expires, I will get to keep all of that $11 credit that I sold it for. Now that you understand put credit spreads, call credit spreads are going to be really easy to wrap your mind around. They're very much the same thing. It's just you have a different market sentiment. With put credit spreads, you're bullish. With call credit spreads, you're bearish. And you'll see what I'm talking about here in just a second. So let's click on call spread up here. We're going to do it on AMD again. So let's say we go down here to the right. We're going to write our option, our call first. Let's set our expiration for June 21st. Give us about a month. We get to collect a little bit more premium because the options are worth more. So let's say we don't think by June 21st that the underlying stock is going to pop above 31.50. So we can actually, let's do 31. So we're going to sell the 31 strike call, but then we have to buy one as a hedge against our sold call, but it has to be a little bit further out of the money. So since we bought the 31 strike or sold the 31 strike, let's buy the 31.50. It's a little bit more out of the money, and it's only a 50-cent width between the strikes, so we're not going to be risking all that much capital. So let's go ahead and click on that and hit calculate. So now you can see you get a $7 credit if this whole spread expires worthless. And in fact, if things start heading in the downwards direction or even just trade sideways and even a little up a little bit, you can start making some money, and you can buy to close at any time if you'd like to close your position. Now again, I just want to reinforce this, all this green coming up in here, that's theta decaying off the other person's option, and you getting to keep that premium. And as long as your short leg is out of the money, you will be collecting premium as each day passes. See how that says 0, 0, 0, 1, 2, all the way over until you've reached your max credit. However, if your short leg is in the money, so like if it's up here, remember the strike of our short leg is 31. So let's say it's trading at 32. As each day passes, you're going to start losing more and more money. Okay, so keep that in mind. It's only occurring if your short leg is out of the money. But that gives you a lot of room to breathe. The stock can trade up, it can trade down, it can trade sideways. It just can't trade a ton in the upwards direction. So everything with call credit spreads is the exact same. You're just doing it with calls, and the same idea still is in play. You're selling an out of the money call if you want a high probability trade, and you're buying one that's even a little bit further out of the money as a hedge against the call you wrote. So I like to see what my potential profit is, what my potential loss is, what my probability of profit is, and I'd like to see all of those immediately as I manipulate at what strikes I'm selling and buying my options at. And these guys allow you to do it. They're Tastyworks, they're a brokerage just like Robinhood. You don't have to pay any money to use their trading platform. You don't even have to deposit any money. You just have to create an account with them. The one downside is every time you log in, you have to see this guy's face, dude, and it makes my blood boil. I don't know what good job at it. Have you heard anyone say that? I've never heard anyone say, good job out of you, bud. I've never heard that. And if this guy made this face in my room, I would punch him right in the teeth. I swear, I'd get my fingers all bloody just for the feeling and the rush of just hitting his ugly mug. Anyway, so you click trading platform there, and we'll make it full screen, I suppose. And you have to log in again. Everything that's going to show up on this page here, you can basically ignore, unless you can look around if you'd like to. But what we're focusing on is trade up here. So go ahead and click trade. So I have AMD pulled up, and on this horizontal bar thingy here, I keep wanting to call it an x-axis, but I guess it's not. You see a bunch of different strike prices. And what you can do is if you go to strategies in the top left, we can see what it would look like to open a credit put spread, which is a short put vertical. That's synonymous with a credit put spread. So we're going to hit go. Now it's going to choose some strikes automatically for us. You can see that these strikes are basically at the money because this little red arrow shows what AMD is currently trading at. So it's trading at 27.41, and it's somewhat in between 27 and 28. Now this red guy down here is the put that we're selling to open, and this green guy up here is the put that we're buying to hedge against our loss or hedge against our put that we sold. Down at the bottom, you can see for this credit spread what credit you would receive, which would be at $24, and you can see your probability of profit, which is 50%. Now, there's a lot you can manipulate here. Oh, and I want to point out that the expiration date's over here on the left, and if you click review and send, it won't send off, don't worry. You can see your potential max loss, which is $26. So let's go back to edit order down here. You can manipulate a lot. So let's say we want to collect a little bit more premium, so we're going to increase the expiration because options with expirations further out are going to have more time value built into them, so their premiums are going to be worth more. So let's add a little bit more time. So we'll collect like a few bucks more or something like that. Sure, we'll take it. But let's say we like that idea, but we are not comfortable with the probability of profit being only 48%. Well, that means we want to sell a put that's even further out of the money, or actually out of the money. The deeper out of the money it is, the higher your probability of profit. However, the less premium you're going to collect because out of the money options are cheap, and when you're selling them to somebody, they're not going to pay much for them. But we like the idea of having a high probability profit, so you can change both strikes of both your puts by clicking this left arrow over here. So let's make it way out of the money, way over here. So you see the credit went down significantly, but your probability of profit bumped up quite a bit. So I like that. I like that idea. But if you go to review and send, you can see that your max credit's $8. Your max loss is $42. It's increased a little bit, but I like trading high probability profit trades. It makes me feel more comfortable. Just don't risk more than you're willing to lose. So you can increase the quantity here of the spread. So you can see the number change, 2, 3, 4. And if you click go, you can see your max profit and loss. Now, definitely keep in mind what assignment would do to you if you get assigned on all of the spreads that you're entering. So you don't want to enter a whole bunch at once. I'd rather increase my risk to increase potential profit by changing my strikes or by changing the width between my legs. And you can do so by pulling these apart manually, or you can just click this width up here and it'll pull them apart like that. And you can see how the credit increases. And the probability of profit's only decreasing because the put you're selling is moving closer and closer towards in the money when you're doing it that way. But you can manually drag one over at a time. Now, if you want to try other stuff, you can go up here to strategies and you can do it with a short call or a call credit spread and all sorts of stuff. So this combined with options, sorry about my dog. He's a cute boy, I promise. Watson! I love you. Use this with options profit calculator to see the whole picture. It makes me really comfortable before I enter a trade, and I highly recommend you to use these guys before entering any options trade. That's credit spreads for you, boyos. Put credit spreads, call credit spreads, go trade them. Sorry I'm releasing this after close on a Friday. I bet you're going to hate me for that. If you have any questions, you can join my Discord and mention me in one of the channels, and I'll respond to you. And do it in the channel so I can respond to you and everyone can see it and learn. Or you can just comment on this video down below and I will respond to you as soon as I can. If I misspoke or just said something straight up wrong, definitely let me know. It's bound to have happened in a video this long. Anyway, I love each and every one of you in a special and unique way. Bye-bye.